the regulatory arm of the Singapore Exchange has announced changes to voluntary delisting rules effective immediately. This comes amid a recent increase in delisting and privatisation. Public consultations were held last year after a series of buyout deals. The regulations now stipulate that in a voluntary delisting resolution, the offerer and parties acting in concert with the offerer cannot vote. The approval threshold is maintained at 75% of the total number of shares held by independent shareholders present and voting. The 10% block will be removed. Previously, a deal could only proceed if less than 10% of the shareholding were against it. Now, another change requires that the exit offer be reasonable and fair for a voluntary delisting to proceed. Previously, an exit offer only had to be reasonable. SGX says that an offer is fair if the price offered is equal to or greater than the value of the offeree securities. SGX RegCo CEO Tan Boon Jin says in arriving at the new framework, it was aware of the need to ensure that exit offers are fair and reasonable so as to better align the interests of the offerer and independent shareholders. He said feedback received raised the question of whether delisting is a sufficiently important decision of the issuer to warrant a high approval threshold. SGX concluded that the threshold should be kept at 75%. To give independent shareholders a say in the delisting in all situations. SGX added that it expects the basis for determining the fairness and reasonableness of the offer to be separately detailed so that investors understand the opinions of independent financial advisors. The regulator will work with industry bodies to develop guidance and standards for advisors and their opinions. SGX also noted that offerers shouldn't use other forms of privatisation to avoid complying with those new rules.